How to size short strangles and short puts for $100,000 to $300,000 accounts. And in this video, we'll go over exactly how to do that and actually how I do it, some live examples as well. My name is Eli. I'm a professional options trader. I manage over $8.7 million. And let's begin with the video. So short puts sizing for 100 to 300 or $100,000 to $300,000 accounts. Very simple. This is the exact framework that I use. So I will be collecting up to 6% of my account capital in premium. So if my account is $100,000, I will be collecting $6,000. Now, the more important thing is actually the margin requirements. I will use up to 30% of my account in margin requirements per position. So exactly what it means. So for a 100K account, I will collect $6,000 in credit. Now this is the maximum, and I will be using a maximum of $30,000 in margin requirement or buying power reduction, depending on the broker you use. I use interactive brokers. They use it. They call it margin requirements, right? For a 200K account, I will collect up to $12,000 in credit, and I will use up to $60,000 in margin requirements per position. Really important. And obviously $300,000 account, I will collect up to $18,000 in credit and up to $90,000 in margin requirement. Now, usually I average about, for short puts, probably about 3 to 4% in the actual premium that I collect, and the margin requirements are usually closer to the 20 to 22%. But these are the absolute maximum amounts because of two things. The margin requirements, they can go up substantially, especially on a directional position like a short put. And for the premium, I don't want to, I just want to make sure I don't collect too much premium. And then if I take a loss, let's say at 50% of credit, I'm not taking a loss at more than 3% of my total account value, which is extremely important. Some people can collect like 15% of credit or 50% of the total account in credit per one position, and then if they take a loss, they at 50% of or whatever 100% of credit, they lose so much money. Now for the management, really important as well, because it plays hand in hand with the position size. I always take profits at 25 to 50% of credit received, ideally 50%. Stop loss is at 50 to 75% of credit received. Usually 50%. I like to keep my stops pretty tight, and I'll exit a position if there are major critical news that moved the price. And of course, no rolling options for me. Hasn't worked properly for the way I trade, at least. Now, if you look at short strangle sizing for the same account sizes, with short strangles, I'm okay to collect up to 8% of the total account capital and premium, just because this is a neutral position, and if price moves up or down, it doesn't affect the position as much as it does with a short put when the short put goes when the price goes against the short put, right? So here I'm okay with collecting a bit more credit, specifically up to 8% of the account. So if we have a $100,000 account, I'm okay with collecting up to $8,000 in credit. And again, the same number, 30K in margin requirements. So the same 30% as we had with the short put. Now for the management, it's almost pretty much the exact same thing. The only difference is the stop loss will be at 50% of credit, and I will never go to 75%. And this is because the vast majority of positions, especially the ones that have a really high probability, they never get to negative 50% of credit. They usually end up profiting way before that. And the very rarely positions do get to this point. And there I will just, I would either close the position, I will roll it, I will do something. Usually I would just close it. So this is it for the management, for the position size. And I want to show you an actual example with interactive brokers, what it looks like for a short put and a short strangle, maybe on different expirations, because it does play a pretty big role if you choose 20 days to expiration as opposed to, let's say, 80 days to expiration, and how much margin it takes. So let's take a look. We are looking at the crude oil futures options chain, and we're currently looking at the 13 days to expiration. So let's see what happens if we sell a short put just outside the expected move. And this, just so you know, the expected move on Interactive Brokers is labeled as the difference in color from on the strike column. So when it goes from dark blue to light blue, this is just outside the expected move. So strike 57. So let's see what kind of credit we can get, what is the margin requirement, and see how we can maximize it. And I will use a benchmark account of $100,000 for this, for all the examples that we go through right now. So this one put can give us $260 in credit. The margin impact is $9,600. So technically speaking, we can take up to 3 of these positions and collect a total credit of $780, right? And we are still under the $30,000 margin limit. And this is the most important thing. The margin requirements are the number one thing you have to keep under control. Usually it's pretty hard to collect a lot of credit. In most cases, sometimes it is possible, but the margin requirements are the biggest thing where people just gonna go bananas on it and end up using 50-60% of margin per one position. And when things go bad and margin inflates, they're just done, even though the position it's still doing quite okay. So if we take this and we put it back to one contract, and let's just sell a Strangle in this case. And then I also want to show you what happens with 42 days to expiration, so you can compare and see kind of the difference. Now, usually the more credit you receive, the less margin it's going to take. So here we can get $570 in credit for about $9,300 in margin. So it's about the same thing. We can take about 3 contracts for the most part, can collect about 1.7% on the account, and with a margin of just under 28% or 28,000 in this case. So again, this number is really important. Now, I live in Canada, and the Interactive Brokers here, or I think generally Interactive Brokers, their margin requirements are pretty high, which is a very, very good thing because it doesn't let you basically open too big of a position. I know with Tastyworks and Thinkorswim, their margin requirements are way more favorable, but then people abuse it, and when the margin requirements eventually inflate, they are in a big loss. So if you're using Interactive Brokers, this is going to be spot on, a pretty safe way to go about it. Now, if we take a look, for example, at 42 days to expiration, we do the same thing. Let's just sell a put first. And if you take a look at this, now we are at 3 contracts already. And as you can see, even if we do one contract, it's only about $6,900 in margin, $520 in credit. So usually the longer expiration date, the less margin requirements you get, the more premium you get, obviously. So here we can probably go 4 contracts, can collect 2% of credit on the account, and about $27,000 in margin, or 27%. And if we do the same thing and we go to a short Strangle, we'll put it in one contract again. You can see that our credit is going up to 1,150 per contract, margin 6,884. So we can do probably the same thing for contracts. And here we can collect 4.5% on the account, and the margin will be 27,000. So it's pretty good. And if we take it a step further and we go to 71 days to expiration, you can see that we can get more and more credit for basically the same amount of margin. But the thing is, we are adding more contracts, right? So it was 4 contracts before. Now we can probably go to 6 contracts. And the only issue with that is you are taking more contracts, so you are taking more risk technically, but you can collect almost $4,000 on this one short put with 71 days to expiration and $29,000 in margin. And if we turn it into a Strangle, your margin is 32,000, so it's a bit more, but at the same time we are collecting too much credit, right? We are collecting almost 9% of the accounting credit. So here I will go ahead and dial down the numbers, which brings us to the sweet spot, just under 30,000 and under 8% of the account, which is $8,000. And in this case, we collect 7,450. So this is how I work. This is what has worked for me through various different market conditions. And again, the biggest thing is just keep the margin impact or margin requirement or buying power, depending on the broker you use, keep that intact, and everything else will fall into place. If you have any questions, let me know. Please email me or just comment in the video or on the video. And thank you again, and I will catch you in the next one.